Welcome to the third of 8 lectures titled The Coming 2026 Financial and Economic Crisis. During the late 19th century, the American political economist Henry George studied the history of the cycles of boom and bust, reaching conclusions based on evidence others had either downplayed or ignored. George observed that the underlying cause is the speculation-driven rise in the rental value of natural assets, of land in all its forms, capitalized by market forces into higher and higher prices that eventually cannot be sustained by the productive sectors of a society. Look closely at what is happening just prior to a serious economic contraction, and one will see the building of asset bubbles in land and other natural assets, in real estate, in commodities, and in financial instruments. These conditions have been in evidence in the United States almost from the moment of creation. There have been severe economic contractions whenever the stress of asset prices brought the economy to a breaking point. This was certainly the case during the 1920s in the United States and in other countries. This was a time of apparent but not very deep prosperity. The economist John Kenneth Galbraith wrote extensively on the causes of boom-to-bust cycles. He was troubled because of what many economists accepted as conventional wisdom in the 1920s. Most economists believed, he says, that economic life is governed by an inevitable rhythm, that after a certain time prosperity destroys itself and depression corrects itself. Thus, almost all economists in the early 20th century believed that cycles were inevitable. What troubled Galbraith, a staunch believer in economic planning to achieve stable economic growth, was that even in the 1950s, there were prominent economists who continued to hold the same old views that only a recession and deflation could cleanse the economy of speculation and excess. Galbraith also pointed to wealth concentration as a contributing stress and cause of the Great Depression. He noted that the proportion of personal income received in the form of interest, dividends, and rent, the income broadly speaking of the well-to-do, was about twice as great as in the years following the Second World War. I would add that a deeper analysis is needed to determine to what extent interest and dividends accrued from reinvested privately appropriated rent. No doubt, among those Galbraith described as the well-to-do, rent-derived income comprised a significant portion of their income and accumulated financial wealth. Some of this income certainly made its way into tangible wealth production, but much of it found its way into the secondary markets for stocks, bonds, and collectibles. Before moving on, it is worth examining the conditions existing in the 1920s more closely to see if Henry George and like-minded analysts who made the connection between the monopolization of nature and nature's rents and these cycles of economic boom and bust are valid. Florida's land boom in the 1920s is the poster child of how markets operating under long-established but dysfunctional rules left to themselves will eventually implode. With speculation in oceanfront lots raging, the Florida coast was hit with a series of devastating hurricanes between 1926 and 1928. Highly leveraged investors faced the disappearance of eager northern buyers and were blindsided by crashing land prices. Many defaulted, causing thousands of personal bankruptcies and bank failures. Frederick Lewis Allen, in his book Only Yesterday, provided the details of how the dominoes fell during this period. He writes, "In the autumn of 1925, the Florida boom was at its height. Men and women were exposed to the most delirious fever of real estate speculation which had attacked the United States in 90 years. The Florida boom, in fact, was only one, and by all odds the most spectacular, of a series of land and building booms during the post-war decade, each of which had its marked effect upon the national economy and the national life. Allen goes on to explain how the agricultural boom during the First World War triggered intense land speculation as farmers were encouraged to borrow to add acreage under cultivation. The need was significant as farmers across the European continent were prevented from planting and harvesting their crops. When the First World War ended, prices for farm products began to fall as global supplies recovered. U.S. farmers suffered, having built up a huge surplus of wheat, the sale of which had been heavily subsidized during the war. The export subsidies were eliminated in mid-1920, as officials determined U.S. exports were sustainable without further subsidies. They were mistaken. Instead, global wheat prices dropped by over 50%, and highly leveraged farmers soon found themselves falling behind on loans to the banks. This should have been an early signal of serious trouble ahead, but the belief in market forces by those in high public office and their economic advisors was unshakable. As land prices fell, investors shifted cash reserves into the stock market, driving up prices far above that justified by corporate profits and forecasts of business activity. By the end of the 1920s, the credit-fueled speculation ran its course. The fortunate few took their profits and withdrew from the market, leaving most others to face margin calls. Panic selling began on the 29th of October, 1929. By 1933, average farmland prices fell to $30 per acre. Some 52,000 farmers declared bankruptcy between 1920 and 1929. An additional 38,000 farmers lost their farms between 1930 and 1939. Farmers everywhere across the United States were hurting. However, in one state, North Dakota, farmers who fell behind on their loans and lost their farms were allowed to remain on and farm the land as tenants. This is because their bank was the publicly owned Bank of North Dakota, established in 1919. This is the bank's headquarters today. When the nation finally emerged from the Great Depression and agricultural commodity prices recovered, many of the farms were sold back to their original owners by the Bank of North Dakota under terms the farmers could afford. Coming to light across the country was the degree to which wealth had come to be concentrated among a small minority of individuals and households. Henry George was one of a small number of analysts who observed a similar level of wealth concentration when he wrote Progress and Poverty, which appeared in 1879. Yet George's straightforward analysis received little attention as the decades came and went. Beginning in the mid-1920s, an assistant professor of military science at MIT with degrees in engineering and business from the Rensselaer Polytechnic Institute, became interested in economic cycles. This was Edward C. Harwood. Others at MIT encouraged Harwood to found a nonprofit dedicated to research on economic cycles. This he did in 1933, establishing the American Institute for Economic Research in Cambridge, Massachusetts. Harwood had already been hard at work on a book published the previous year with the title Cause and Control of the Business Cycle. Harwood was certain his research had uncovered the reasons why economies experienced repeated cycles of boom and bust. Early on, Harwood urged readers to be patient and not to jump to conclusions. He wrote, "It is advisable to sound a note of warning against deserting the scientific attitude for the shortcut to the wrong answer which so many have already followed. It may seem obvious that if a beneficent government would only monetize silver, or set the printing presses to work, or embark on some other scheme similar in principle, all would be well. Unfortunately, Depressions will never be cured so easily. The facts and figures available at the time to Harwood convinced him that the main problem was the rules governing or not governing the issuance of loans by the nation's banks. All during the period of extreme prosperity, the banks have been making new investments at a faster rate than the growth in savings has warranted. The total of investment-type assets has, therefore, steadily increased relatively to the savings justifying them. The reversal of the process is the condition called deflation. In an effort to tame the beast, Harwood urged that the Federal Reserve force discipline on bank lending in order to control inflation. By determining certain limits beyond which inflation will not be permitted to proceed, the Federal Reserve Bank can, by selling securities and raising the discount rate, force member banks to curtail new originations of credit based on investment-type assets. Harwood does not in this book indicate he has any familiarity with the economics of land markets or the impact of the private appropriation of rent on the production or distribution of wealth. However, at some point after 1932, he was frequently engaged by individuals who accepted Henry George's analysis of the cause of economic cycles. Gradually, as he studied the role of rent, Harwood acknowledged the destructive character of the existing tax regime. He had come at least part of the way to the conclusions reached by Henry George. Arguments were raised by those on the left that the nation's socio-political arrangements and institutions amounted to socialism for the rich and capitalism for everyone else. Those on the right argued that government intervention on private economic arrangements was the main problem. In a small volume titled Useful Economics, published in 1970, Harwood reflected on the state of socio-political arrangements and institutions in the United States. In the United States, ownership of terres forestes is still widely spread among the population. Moreover, the extent and therefore the effect of such special privilege have been modified by the taxing procedures generally used. Specifically, the income tax to some extent lessens the takings of those who held monopoly privilege, even if it also hamstrings the nation's potential Fords and other processing geniuses of the future. Harwood had failed to accurately diagnose the situation. What this chart shows is that from the late 1970s on, the concentrated ownership of household wealth in the United States climbed back up. By 2007, concentration reached the level existing on the eve of the Great Depression. The concentration of household income in the U.S. accelerated at an even faster clip during the presidency of George H. Bush and has continued without interruption. These income statistics were released in April of 2022. In 2008, American households divided up an aggregate income of about $12.4 trillion. By 2018, this figure had grown to $17.6 trillion. With the financial crash in 2007, a significant portion of aggregate household net worth associated with financial assets and equity in a residential property partially or totally disappeared, as underlying land values lost part of mid-cycle gains. The losses were most severe wherever subprime mortgage lending was high. Minority households lost homes to foreclosure sale at a rate 3 times greater than non-Hispanic whites. Here we are at the end of 2022, and the forecast by some economists is for property value declines of up to 20% after a decade of continuously rising values. California once again leads the nation in foreclosure starts, followed by Florida, Tennessee, Illinois, and Ohio. It took about 3 years for the land market cycle to renew its upward climb after the 2008 crash, stimulated in part by the huge monetary infusion and by falling interest rates on mortgage loans. For those households who had little or no debt and experienced no significant interruption of income, their unrealized net worth began to recover as land and property values climbed and continued upward to well above the 2007 levels reached on the eve of the crash. This chart compares Texas with the United States. The role played by the nation's banks and other financial institutions has received considerable attention by economic historians and critics of our economic institutions. What occurs again and again is that bankers exhibit a strong tendency to move away from prudent lending and investment practices when stresses in the economy threaten their transaction volume, their desired market share, and their desired profit margins. Always a consideration for banks and bank regulators is what is the prudent level of risk-based capital to hold. The 2007 crash was not unique. History has important lessons to teach us. During the so-called Roaring Twenties, an average of 70 banks failed annually. Many were small rural banks serving troubled agricultural communities. Falling crop prices drove land prices down by 30 to 40% between 1920 and 1929, and as earlier stated, a growing number of farmers defaulted on bank loans. The situation worsened during the early 1930s, and bank failures escalated. During the first 10 months of 1930, nearly 750 banks failed. By the end of the decade, over 9,000 banks closed their doors. Depositors lost $140 billion, equivalent to $2.8 trillion today. In response, the Federal Deposit Insurance Corporation was created in 1933, offering surviving banks depositor insurance beginning in 1934. Federal Deposit Insurance ended widespread bank failures until the stagflation of the late 1970s, when competition from the new money market funds brought the U.S. savings and loan industry to the brink of collapse. Mergers and many bank closings followed. As indicated on this chart, several thousand savings banks and savings and loan associations and some commercial banks failed during the 1980s and early 1990s, after losing their deposit base to the new money market funds and trying to survive by taking on greater risks in search of higher yields. As their cost of funds steadily increased, the thrifts were absorbing increasing losses on their low-yielding fixed-rate mortgage loan portfolios. Legislative relief came, but too late for many. Not until 1983 were the thrifts and commercial banks able to compete with money market funds by issuing their own higher-yielding certificates of deposit. What followed was a period of banking deregulation that fostered consolidation of the financial services industry, allowing thrifts and commercial banks to merge and to do business across state lines. Thanks to the new laws, the financial sector players were quickly becoming too big to allow to fail. Then in August of 1987, Alan Greenspan was appointed by Ronald Reagan as the new chair of the Federal Reserve Board of Governors. He remained to oversee monetary policy during the administrations of George H.W. Bush, Bill Clinton, and George W. Bush. It was under Greenspan's leadership that the Federal Reserve began cutting back interest rates and standing aside while banks took on increasing risks. One outcome was that with each such cut, an increasing number of potential property buyers were able to qualify to carry higher and higher levels of mortgage debt. The markets capitalized this debt-carrying capacity into higher land and property prices. The prices obtained for investment properties also climbed, and owners sought to recoup this cost by raising apartment and housing rents as leases expired. By the time Greenspan left the Federal Reserve in 2005, the nation's property markets were fast approaching the point of maximum stress, weakened by the rapid growth of the fraud-plagued subprime mortgage loans and the private label mortgage-backed securities issued by the banks and collateralized by these high-risk subprime mortgage loans. In the face of a new period of bank failures after 2007, the Dodd-Frank Wall Street Reform and Consumer Protection Act was signed by President Barack Obama on the 21st of July 2010. One part of the bill increased deposit insurance to $250,000. One might ask who this increase protected, savers or the bankers? The Federal Reserve reported in 2019 that the median combined checking and savings account balance of a U.S. household was just $5,300. The average balance was $41,600. Tightened stress tests governing risk-based capital resulted in the closing of 465 banks by the FDIC between 2008 and 2012. Once again, history repeated.